the financial year that has gone by and look at the year ahead. Q4 came in at up 0.7% on reported and flat on constant currency, which is weaker than we had expected. But we had several signs of strong performance on margin. We did good at 24.7%, as well as on revenue per employee. The company grew by 2%. For the first time, we had a significant outpacing of the revenue with the number of employee additions. 3.3%, we achieved this growth with 3.3% employee net employee addition, which means that our revenue per employee, revenue per FTE went up by 2% over the year. The utilization at 81.7 is at a high of many years, I think 10 years, Ranga.
Q4 utilization.
Yeah, Q4 utilization is at 81.7, and on
82.
Top account growth, we did well. Top 25, top 10, top 5. As well as large deals, we did more than 800. Although the mix on large deals is something that we want to focus more on to make sure that there is more of new large deals in there. But we did just above 800 million in large deals. The 100 million accounts went up. Now it is at 19. It was 12 when I started. And so overall, on all these metrics, on operational efficiencies, on cash flow generation, we did well, and Ranga and Praveen will talk about this in a little bit more detail. When I look at the performance of our software and services, and the new services in particular, we did quite well. The software, so Mana, Skava, Panaya, has gone up by 56% year on year. Mana has been doubling, more than doubling, quarter on quarter. Now it is the fourth quarter of Mana. If we include Edge into that mix, it is a growth of 42% year on year. So we are quite happy about that. As well as our new services, many of our new services in the digital areas, in Internet of Things, cybersecurity, etc. Some of these new renewed services areas has been growing significantly, and starting next quarter, we'll start to call these out separately and report on these. The employee attrition continued to improve, 13.5% or so. Especially the top performer attrition has continued to be in single digits, which is something that we are quite proud of. And we have rolled out our RSU plan and generally a creation of an entrepreneurial spirit inside the company, because I believe that is absolutely vital to the future that is ahead of us. So overall, several great strides forward along the execution of our strategy. And as I look at the time that is ahead of us, it is very clear that when I look at the overall performance of Infosys right now, roughly 65% of our workforce produces about 55% of our revenue. That is where there is a commoditization, where there is a strong need to bring automation and productivity improvements. And about 35% of our workforce, which produces 45% of our revenue at a much higher RPE in the new innovative areas. We have to double down on these areas. And so the imperative overall is as clear as it can be, that we have to bring automation and AI into everything that we do in our work to improve the productivity, to bring innovation, to bring process transformation. And then with that improved productivity, we have to become more innovative. We have to become problem finders. The advances in AI in our lifetimes will get to a point where more and more of the problem solving will be done mechanically. Things that we can articulate mechanically will be done automatically. Therefore, the human frontier is problem finding. And that is why a culture of education, of bringing design thinking into everything that we do, working closely with customers on their most important strategic areas, strategic problems that they see, is something that is crucial for us. So we are continuing to focus on that. And as I look at the year ahead, I see more of that, more of automation, more of innovation fueled by education. Praveen?
Hi, gentlemen. I think the audio is Hi, gentlemen. Kritika Saxena from CNBC TV 18. My first question to Vishal. As far as the guidance is concerned, Vishal, analysts were expecting a slightly higher guidance, 6.5 to 8.5%. Is this a conservative estimate? Can you increase this further? I know you said that there are unexpected execution challenges. If you can specify on what the challenges have been, which will continue. To Ranga, 13,000 crore rupees capital allocation you have already pointed out to be paid out to shareholders. Can you give us a sense on the exact timeline across FY18? When can we expect the board to take it up? Will it be in a staggered form or in one shot? And to Mr. Praveen Rao, very quick question as far as the appointment of Ravi Venkatesan is concerned. Is this after the external consultations and conversation and recommendations of the founders? Thank you.
On the 6.5 to 8.5 guidance, this is what we see right now. It is a challenging environment out there that we see with what is going on in the world around us. It is, and also of course the Q4 performance has an impact on how we see the evolution of the year. So we were also expecting a higher numbers there, but given Q4, this is what we are seeing presently. When I talk about challenges, you know, there is the environment that we are working in with the increasing digitization, increasing commoditization of many of the services, and a strong need to bring automation and strong need to transform away from a people-only model towards bringing more and more software into the services that we bring and to get into the more advanced and innovative services with our clients. So that environment, that need for overall transformation continues to be a very strong one that is driving what we do. And then beyond that, of course, the geopolitical things that have been going on, the visa atmosphere and so forth, those are things that we have to focus on. And then, of course, other, distractions that we have had to deal with over the course of the year and especially in the last quarter. So this is what I was referring to. But I think given all of that, our performance is something in many key areas that I'm really proud of. Our core business has grown well. Our customer satisfaction has been the highest it has been since we started measuring it over the last 12 years. The analyst reports around our core offerings, our new offerings on Mana, on Scava and Edge, put us at the best in the world. And there are strong customer testimonials which we have in our press release that went out today. So overall, I am quite proud of the results that the team has achieved.
On Ravi Venkatesan, it was based on the recommendation by the Nomination and Remuneration Committee. Beyond that, it's a board matter.
Hi. So before I address that point, looking at fiscal 2017, there are two key outcomes of fiscal 2017. One is we have held the operating margin steady at 24.7%. If you recollect, we had indicated that our band is 24 to 25. We are at the higher end of the operating margin guidance that we had given. This was possible despite the lower revenue trajectory during the year, cross-currency and the pricing challenges and so on and so forth. It was only possible because we had a laser-sharp focus on the operational efficiency that Vishal talked about, whether it is utilization or on-site employee cost as a percentage of revenue, subcon cost as a percentage of revenue and so on, which helped us to hold the margin steady despite. That's one key outcome. The second key outcome is on very strong cash generation. I'm very happy to report that for the fiscal 2017, cash from operation activities crossed $2 billion for the first time, and that's the highest. I think we focused on the efficiencies, holding the margin steady at the higher end of the guidance that we had given through several measures, and that also resulted in a very strong cash generation. These are two principal outcomes other than the points that Vishal talked about on the per capita revenue. Coming to capital allocation policy, I think the board's objective was to address three key aspects. One expectation is clearly investors want some amount of predictability of out of the future cash, how much are you likely to return? For example, for every $100 of free cash flow in future years, how much will be retained in the business, how much will be returned to the shareholders? I think the first part of our capital allocation policy talks about 70% of the free cash flow. That is one part. The second part of the capital allocation policy is also that out of the cash that we have as on balance sheet today, close to $6 billion, how much is expected to be returned to the shareholders in a particular time frame. I think our capital allocation policy addresses both. It clearly says up to 13,000 crores, which happens to be approximately 34% of the cash that we hold as of today on our balance sheet, which is in line with some of the other, other announcements that we have seen with the peers as well. This also takes into account our strategic and operational cash needs for the next couple of years. I think the board has clearly said that up to 13,000 crores, and it is also described the mechanism and options on mechanism. As you know, we are listed in multiple global stock exchanges. We are listed in NYSE, we are listed in Euronext London, we are listed in Paris, and so on and so forth. So we are required to comply with multiple regulatory requirements. I think keeping in view, the board has clearly said we will do it in fiscal 2018. So let's wait for the appropriate time.
Thank you. Hi, Chandra Shrikant from ET Now. Entire management's dressed in black and blue today. I don't know if that's indicative of the mood on campus. But Vishal, there is some disappointment, you know, in the tone of your commentary. I think people would have expected more optimism, more clarity on the demand trajectory. Even on the guidance, you know, considering Infosys has missed guidance for last 3 times in the last fiscal year, have you factored in that cushion in this guidance that you've given? And going by this guidance, is it safe to say that the 2020 targets that you've set out are more of moonshots now and, you know, not something that's realistic? Because, you know, the 2 billion capital allocation plan also reduces the cushion you have to, you know, grow inorganically. That's for you. Praveen, if you can give us a sense of, the different verticals, because, you know, how BFSI and consulting is doing will be key to gauge demand going forward. You had highlighted some pressure in retail and telecom in a recent interaction with analysts. Ranga, just want to understand the new margin band that you've given, 23 to 25%. Does this factor in the appreciation of the rupee? And is there a risk of an EPS decline as far as FY18 is concerned? Thank you so much.
So moonshots, you know, it's a great word. I love moonshots. What good is an aspirational goal if it is not a moonshot? And so yes, it is. It was always a moonshot, and it continues to be a moonshot. Of course, with these numbers that we have, it becomes steeper to get there. But the main point, and as I have always said, it's an aspiration. The main point is the way it frames financially the aspiration that we need to get to, which is 20 billion. So to double our revenue, meaning achieving strong revenue growth purposefully without compromising on margins. As Ranga said, we had strong margin performance this year. Indeed, not only not compromising on margins, but improving the margins to 30% and improving the revenue per employee, which is the ultimate measure of are we outpacing the commoditization that is happening in our industry through the use of automation, and are we elevating ourselves to do the innovation, which is measured ultimately in revenue per employee, and it's to get it to 80,000. So that 20, 30, 80 continues to be the frame that we'll go after. Whether it happens on 2020 or some years down the road, that's a different matter. In terms of guidance, yes, of course, you learn from the past. That is the whole point of being a learning company and being people who learn continually across our lives. But as I have always said, we give our guidance based on minimizing the asymmetry of information between what we see and what outside of the world sees. And we continue to focus on that. One of the analysts had referred to it as saying it like you see it, and that's what we are doing. And obviously, you learn from what has happened in the last several quarters.
Hi. From an industry vertical perspective, we continue to be positive on financial services. In Q4, we saw 0.5% constant currency growth. For the year, if you exclude Finacle, we have seen some double-digit growth in financial services. In US particularly, we have seen a couple of rate hikes, easing of regulatory pressure. So we expect some of this spend to come back later in the year in terms of discretionary spends. So we remain fairly confident on the financial services. On manufacturing, it's been flat this quarter on a constant currency basis, but for the year, it's been low single digits. So when you look at manufacturing, there are two parts. If you look at the core industrial manufacturing, we are doing reasonably well. We are seeing good spend there. But we are really challenged on the high-tech space. The whole industry is going through troubling times. They are actually transforming into a reduced they are transforming into a cloud-based offerings, which necessarily means reduced margins and margin pressures for them. So there is a lot of focus on cost takeout and some amount of insourcing as well. So we expect that softness in high-tech to continue, whereas rest of manufacturing, we are fairly confident. On the retail and CPG space, for this quarter, we saw on a constant currency basis decline of about 3.6%. For the year, I think they grew about 7 to 8%. But if you look at it on retail side, I think there is a lot of disruptions happening. This year, we have seen a record number of store closures in the retail vertical, record number of layoffs. So we expect retail to continue to be soft or volatile in the coming year. On the other hand, CPG has done well. We expect continued uptick on the CPG space, CPG and logistics space. And if you look at healthcare and life sciences, on the healthcare, while this quarter we have seen some softness, but it was coming off a very good quarter 3. So we expect, we continue to see good trajectory in healthcare in the coming year. But life sciences for us is relatively soft for us. I mean, we have not done well this year, and one of our challenges in consulting has translated into a bigger impact in life sciences because we had a significant amount of influence on consulting in life sciences. So, so we expect some degree of softness in life sciences in the coming year. On the consulting side, I think we are on a recovery path. This year, the focus is more on turning around consulting, focusing on profitability, focusing on purposeful growth. So we will focus less on actual growth, but we'll focus more on getting the consulting foundation right so that in the coming years we can grow it much faster.
Hi, Sindhara. So coming to the first question on, you addressed it to Vishal. Look, out of the total cash balance of close to 6 billion, we are saying up to 2 billion. So still, we have sufficient cash to look at the strategic requirements, whether it is M&A, whether it is the investments that we need to do. Not that, we do not have sufficient cash to do that. So we do. Coming to the margin guidance that you talked about, if you look at the band is wider, 23 to 25. But if you look at our FY17, as I was telling earlier, our band was 24 to 25. We ended at 24.7, despite the lower revenue trajectory, lower pricing, and cross currency and things like that. That was because of the very sharp focus on the operational efficiency that I talked about, such utilization, on-site employee costs, subcon costs. Now, if you look at this year, all those efforts will continue. Now, we do believe that we have a lot of operational efficiency improvement opportunities, and like Vishal talked about, we are encouraged by the sign of per capita revenue improvement this year. So the automation acceleration is something that we want to really focus on in this year. Now, these are the two factors which we want to kind of make sure that is kind of fully played out. Now, coming to the guidance on the margin 23 to 25, one element, as you rightly talked about, if you look at the average rupee rate of last year to the closing rate, it has depreciated by a little over 3%, 3.3%. So that is one thing to, that is one factor that we need to take into account. The second factor is also that we also want to make certain investments in on-site DCs in the United States to address any potential risks. So there will be some operational costs addressed, but I think it is important for us to kind of look at that and proactively address that piece. So while the range is 23 to 25, as we have done, as we have said in the past, our focus is to optimize our efficiencies and work on automations so that to what extent this additional impact of either the rupee and the on-site DCs we could mitigate. Now, other one, see, I think operating margin is the real driver, right? So we would like to, even if you look at this year, we are 4.3% EPS growth year on year, despite all the lower revenue. For example, we had guided 11 right earlier. So I think the focus would be to optimize both the operational efficiencies, look at maximizing our other income streams, so that we want to make sure that we are on a steady growth. So it is too early to comment on that.
Good morning, gentlemen. This is Sajid here from Bloomberg Quint. I have a couple of questions. So one, you came out with the guidance, Vishal, you came out with the guidance of 6.5 to 8.5. My question is that, on a compounded quarterly growth rate, you need to grow at 2 to 2.8% every quarter to achieve that by the end of FY18. Are we in line to achieve that kind of thing? Secondly, I wanted to check with you on your 2020 aspirational vision, which is there. Is it time to recalibrate that vision? Because the street wants to know, I need to have predictability in your earnings and where you're going from here on. Is it not better that we recalibrate the 2020 vision to be more realistic in nature and not a moonshot or an aspiration, what you call it? So that brings in more stability in the way it is going to work. And third question is, what is the role of the new co-chairman on the board? You're getting two heads here. We have seen this model earlier as well. It didn't work out. There were multiple heads coming in. What is the role? Can you just give us a clarity on what these two chairmen will do on the board and what is the role of each of them? For Praveer, the employee revenue per employee is around $51,000, and you're looking at $80,000. The revenue hasn't gone up in last 1 year. It's still at $51,000 there. How do you plan to increase the revenue per employee going forward? And secondly, what is the kind of hiring plans, net hiring plans for the year? For Ranga, we saw the margins of, you spoke about 24 to 26 last time when we met, now it's 23 to 25. We were looking at a vision of 30% margin, and you're bringing down the lower base down there. What is the reason for it? And when you say the capital allocation to up to 30,000 crores, so up to for buybacks and dividends, additional dividends,
yeah, let me start.
Does it mean by saying that any inorganic growth is out of the question now?
I think let me address your last question first. No, our capital allocation policy has stated that up to $2 billion out of close to $6 billion is planned to be returned during the course of this financial year. So we still have $4 billion. And when we announced this capital allocation policy, all the strategic cash requirements, which could be M&A, which could be the capital expenditure, strategic investments like the one we are planning in the US, all those are taken into account. Likewise, we have taken into account the capital expenditure requirements. So we still have, if you see today we have close to 6, we're returning 2, up to 2 billion. Then the balance is there. Then the company also generates free cash flow in the future years as well, right? If you look at this financial year, we generated total free cash flow of approximately $1.7 billion, out of which, if you take out the dividend payments and things like that, finally we'll be left with about $500 to $550 million. So that itself, if you look at the next couple of years, that will be an incremental accretion. So we have looked at the current cash, the future cash that is going to accrue, a combination of these two. After that, what is the expectation on M&A? What is the expectation on capital expenditure? After taking into account all this policy has been announced. So it is incorrect to say that we do not have enough capital for any future M&A or any enough additional strategic investments that we need to do. So that is point number one. So we clearly said up to 2 billion. Now coming back to your margin, as I earlier stated, we were 24 to 25, we are at the higher end of the margin, 24.7. And even today we are given the margin guidance of 23 to 25. So last year also similar questions were there in the beginning. Hey, your revenue trajectory has come down, your pricing decline has happened. How will you maintain your margin? So we focused on the operational efficiency on multiple dimensions. Utilization, as Vishal said, is 10-year high in Q4. Likewise, subcon expenses as percentage of revenue is steady. And our operating margin for the entire year is 24.7. similar to previous year despite all these aspects. We'll continue to relentlessly focus on operational efficiency. And the other positive element which we noticed in fiscal 17 is really the rate of addition of employees into the company is slower than the rate of revenue growth, which is essentially means that do we need to, is it really on account of automation or high utilization is something that we are looking at. So automation accelerating during this year is something that we need to focus on, plus the operational efficiency parameters. A combination of these two is where we need to address on the operating margin. Coming to operating margin, why from 24.7, why we are given 23 to 25? Clearly, rupee is one aspect, as I was mentioning earlier.
But you also have tailwinds, right, which is coming in terms of USD and GBP.
No, it's not the operating cross currency is there, but if you look at the volatility, the rupee substantially has impact on our offshore costs. If you look at the offshore costs, if the rupee appreciates, then when you reflect back the offshore costs into dollars, that is where really the margin impact is. Now, if you look at the rupee has appreciated 3 to 3.5% on an average to closing basis, that itself is about 0.7. But there are also we also proactively looking at the U.S. on-site development centers to address any potential changes there. So we'll relentlessly focus both on operational efficiency and the automation pieces. We'll see the results.
To your questions around the co-chairs, we have now Sesh and Ravi as non-executive co-chairs. So my job, the job of the three of us and our management team is of setting the strategy and executing on the strategy and the operations of the company. The board's job is the governance, etc. And so there is a very clear separation. So it doesn't, in that sense, we have a very cohesive board, and I have always appreciated the feedback, the guidance, the advice from the board. But in the end, it is our job to run the company and to set the strategy and to execute that, and that continues unchanged. On the 2020 and I guess that was your second question. Yeah, that is something that it has always been an aspiration. The main point there, as I said earlier, is the framing of the strategy in a financial manner, which is steep revenue growth to 20 billion, improving the margin and improving the revenue per employee. As Ranga talked about, we have demonstrated that despite the early phases of this transformation and despite the headwinds that we have seen, we have kept our margins. As we look at the time ahead, we have this triple, pressure on margin from the cross currency that, like Ranga talked about, from the investments we need to make in the US, and the investment that we are making in software and in the new areas. So all these, despite all these, we have compared to last year, and despite the lower revenue growth, we have only lowered the margin by 23 to 25, which means that we are intensely focusing on operational efficiency, intensely focusing on costs, and making sure that, especially automation in the core parts of the business, continue to drive forward. If you look at revenue per employee, in the software areas that I talked about, which are growing by more than 40% year on year, the revenue per employee is already more than $100,000. It is actually, I think, more than $125,000. If you look at the new areas of our services, what I mentioned, the 35% of our workforce working on 45% of our revenue, there the RPP is more than $72,000. So these are, and that area has grown by close to 20% in the course of the last year. So the way that we will achieve these nonlinear growths in revenue and in revenue per employee without compromising on margin while also growing the margin is by this dual focus of these new innovation areas of software and by bringing automation in an intensely focused way to the commoditizing part of our business. And on that front, you already see the signs of success.
What about the quarterly growth rate of which you need to achieve?
Obviously, we have done all that backfill voodoo on all quarter-on-quarter growth. I don't know why the industry is so obsessed with quarter-on-quarter growth, but yeah, of course, 6.5 to 8.5 assumes whatever the quarterly thing adds up to in there. But the important thing to realize is that in our lifetimes, we will see AI systems. We had an astonishing experience with a client here in Asia earlier in the last quarter, where we were able to transform, actually completely eliminate a small team of lawyers by using Mana to automatically analyze the non-disclosure agreements and other contractual documents, completely automating that and only escalating exceptions to these agreements to senior lawyers when necessary. In our lifetimes, we will see AI systems achieve the competence, the skills, that any problem that can be mechanically articulated will be solved by AI systems. I see a tremendous urgency of transforming ourselves into a next generation company which is focused on delivering innovation, which is focused on delivering next generation problem finding and design thinking with our clients, and automating as much as possible of the work that should not be done manually. In that journey, you know, the quarter-on-quarter results, while they are important and we have to live by those, don't matter quite as much.
I think Vishal already responded. Employee addition for the year?
Future.
I mean, we can't talk about the future. No, we can't talk.
Given the
Just go ahead, ask it. Okay.
Good morning, gentlemen. My name is Sakshi. I'm from Z Business. Vishal, my first question will be with you. There are a lot of challenges that the IT industry is grappling with from abroad. Like look at US visa policies or the recent tweaking of the policies which have been started by Donald Trump, and also the Brexit issue. Now the Brexit process has started. Even in Q3, we did see an RBS contract ramp down last time. So what kind of challenges are you seeing? Which is the biggest risk for you at this point in time? And what kind of strategies are you making to mitigate any sort of risks on that front? Praveen, my next question will be with you, and I wish to ask you about the attrition rate that has now come down to about 17%. So is this comfortable for you, or is there any room for further reduction in the attrition rate going forward? Ranka, my next question will be with you, and I want to ask you about, you did talk about the rupee being a big factor, and which is why the margins are at 24.7% and the outlook is being reduced to a 23 to 25% bracket, but there were tailwinds also this quarter. So what kind of impact of tailwinds have you had in this quarter? And going forward also, looking at the recent reports which do say that rupee is likely to appreciate further for some more time. So are we going to see some more pressure going forward on the margins? Thank you.
Actually, on the visa and the regulation and all that matter, I have always said this, you know, I am myself a US citizen, and I think the role of visas in our industry has become too strong over the last 15 years or whatever, and we need to focus on delivering value independent of visas. We have to deliver value to our clients in a way that is strategic to them, that is relevant to their future, and obviously we have to comply with the regulations as we do that. And when we think about this, it necessarily means that we have to have a mix of the best local talent that we can bring and mix that with the best global talent that we can bring. And we bring technology to cross some of these divides with next generation collaboration capabilities and presence capabilities and things like this. So I think about the visa situation as something that affects the entire industry, and we have to live with that. But the main focus of our work must be on delivering value to our clients where they are, and in the best possible way with the best talent. And a healthy mix of local talent is actually a very good thing. We have been doing that. We are very strong locally in the United States. It is a huge market for us, and it is one where we are very deeply committed to in terms of local hiring, local training, establishing training centers in the US, not only for ourselves but also for others. The work that our foundation does, I mean, we have trained close to 200,000 school kids on computer science from the work of the foundation in the US, and trained several thousand teachers into computer science teaching. And so we are deeply committed to our presence there, and that is, I believe, a more healthy way to go about this. Yeah, you know, Brexit, these are...
We navigated that well.
We have already navigated that, we have demonstrated that, and it has now been, what, 3 quarters of this, and the situation with RBS and so forth. These are factors that affect everybody, and these are the, you know, the vagaries of doing business in the times that we live in.
On the attrition front, the 17% at group level is perhaps one of the lowest in recent times. And if you look at Infosys Limited alone, the attrition has come down this quarter to 13.5% from 14.9% earlier. But more importantly, the high performance attrition, whom we track very clearly, has come down dramatically. It's in single digits. Going forward, I mean, we are more worried about our focus is on high performers, retaining high performers. So focus will be more on that rather than the overall attrition. Apart from the attrition, I mean, even when you look at the employee engagement, we have now launched a quarterly employee satisfaction survey, and whatever we have seen in the last 2 quarters, the feedback has been extremely positive. So we are fairly comfortable with where we are on a people front.
So coming to rupee, I think that's a $10 billion question. Nobody can really answer how the rupee would really move. But having said that, yes, if you look at it has already on, if you look at the FY17 average to period end, it's almost 3.3%. Of course, we have to navigate that. If you look at last year, as Vishal was mentioning earlier, due to Brexit and US elections, there was huge volatility on dollar, pound, dollar, euro. We navigated that. And that also had pressure on the operating margin last year. But we had to navigate that. We had to focus on operational efficiency so that, we try to impact as, to what extent possible. So by and large, our relentless focus on those fronts will continue.
I want to understand from you in terms of putting the entire structure in place, what really is being done.
So I'll have Ravi answer the Americas DC's question, and then Rajesh answer the consulting question.
Yeah, so thanks for the question. So, in many ways, global talent, IT talent, is in shortage both in India as well as in the US. So we made a huge attempt since the inception of this firm to create a finishing school, to create talent which is productive for technology-led projects. So in the last few years, we made a similar attempt to hire in the US, both laterally as well as fresh graduates from campuses. What we're doing, and our endeavor now, is to step that up significantly in the US. And that's the right thing to do, because you want to look at local talent, enable local talent, build local talent pools organically, and then look for global talent to supplement it wherever you don't have enough available. So last year we hired from schools in the US, and we got them to Mysore, and we actually trained them and we enabled them. This year we're doing in bigger numbers, so we would set that up in the US and locally train, enable, and make them productive in the US. So that's one part of the strategy. The second part of the strategy is to just step up the overall hiring in the US so that you are less dependent on the global talent pool to go back and forth from the US to India. The third is actually setting up centers, because once you have large talent pools, you need to have centers in the US. So the centers in the US are actually going to be built based on client clusters, availability of talent, as well as local enablement from the government. So this is a part of our plan. We started this process in the last 1 to 2 years. We are just stepping that up as we go forward. So this is a part of the journey. So the overall talent plan will kind of get tweaked and recalibrated, and that's what Praveen and Vishal were talking about.
Is there a percentage in terms of your employee pool that you're looking at, that the local hiring, we would perhaps have about 10, 12, 15% of our local talent as a part of our team? Is there anything?
So there isn't a percentage we are looking at. What we are looking at is to organically build those talent pools in the US and use them for our customer needs, and then supplement it with the global talent pools, so that we de-risk out of the visa, the uncertain visa regime, and actually make the local talent pools the primary and the going-in talent pool which is needed for our clients in the US. And the centers are actually a part of that process, because once you have large talent pools, you need to have centers which will house them.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.